All right, well, great, everybody. Welcome to the first of many installments of Fintech Banker School. Today, we are kicking off with our first broadcast here from the new FinReg studio at Nelson Mullins. This is going to be kicking off in collaboration with us hosting Fintech Banker School August 26th in Atlanta, where we're inviting fintechs, banks, regulators to come and learn more about how banks are integrating fintech into their systems, as well as some of the recent concerns that regulators have had. So let me start with a shameless plug for Fintech Banker School. August 26th will be kicking off at 9 a.m. More information is available online at nelsonmullins.com. And if you have any issues signing up, please feel free to email us. Really excited today. Obviously, lots in the news dealing with some of the changes the regulators are pushing through related to fintech. And perhaps one of the biggest developments that we've had lately is the FDIC, during a meeting, came out with proposed rulemaking amendments to the broker deposit rules that are really impacting a lot that's going on within the bank fintech partnership realm. And so today I'm joined by three of my colleagues. Lashania White is here at the FinReg studio. Craig and Mariana are joining us remotely. Today we're going to be talking about how these new rules could impact financial services. And so Mariana, let's go to that first slide. Today what we're really talking about, Lashania, is a kind of one end of the spectrum, right? So a lot of times when I'm first talking to banks and they're thinking about doing fintech, one of the biggest challenges I have in explaining to regulators, I was actually with the FDIC last Monday, is that all fintech's not created equal, right? Meaning fintech is really a spectrum. And what we're talking about today is kind of the far end of that spectrum, right? Where we're actually doing banking as a service, we're opening accounts, we're using the bank's infrastructure to back in fintechs. But to kind of keep us in perspective, this rule potentially has implications to the whole spectrum of bank fintech partnerships that we're talking about. But today we're going to focus on how this new proposed rule may impact some of this. And so, we're going to be talking about when we bring those those different areas of the spectrum. So banking as a service, pass-through deposits, FBO accounts, how this potentially could change some of that and what banks need to be thinking about. So as we noted, July 30th, 2024, FDIC had their meeting, approved a series of proposed amendments, and smart bank lawyers all over America are debating whether or not this is actually what their intent is to actually put in place this proposed rule, or is this more kind of we're going to take you from here all the way to the other end, and we want you to put some comments in, see kind of looking for feedback, and did they kind of go to the other extreme just to kind of scare people and get a lot of feedback? So, TBD whether or not they're going to try to walk this rule back. We're going to talk about a lot of the concerns that different folks have related to the proposed rulemaking. But, if we think about the history, prior to late 2010s, all of this was just on a one-off basis, right? So the FDIC had general guidelines about broker deposits. They were written back in the 1970s for old-fashioned deposits, right? Where, I'd go to a marketplace, I'd buy deposits from another bank, or I'd broker CDs, or I'd broker accounts. And so the rules were kind of written for that. And so what we saw in the 2000s, late 2000s, early 2010s is really this shift from traditional broker deposits to the FDIC on kind of a one-off basis dealing with fintech-related deposits. And if you think about what this rule is trying to get at, is the broker deposit rules are designed to classify deposits, right? On one end, you have traditional retail deposits. Brad, Lashania, we each walk into a bank, you open a savings account, I open a certificate of deposit. The FDIC is like, yeah, that's great. Those are really good deposits. They're sticky, right? The likelihood that if I have a 1-year CD with a bunch of penalties, I'm going to suddenly rip that out of the bank, run away, go somewhere else is pretty small. If you have a savings account, probably a little bit more risky than my 1-year CD, but not quite as risky. Checking account may be more risky, but broker deposits, the original regulations were really kind of targeted at if I'm just going out and buying these things from a broker, and a broker is calling up 30 banks and saying, Lashania Bank, what rate are you going to offer me? Craig Bank, what rate are you going to offer my customers? Mariana Bank, what rate are you going to offer your customers? And the likelihood is, as soon as I'm not the highest interest rate, you're going to move down the street. And so we've got to kind of punish the banks, as the FDIC is thinking, or at least we've got to take that risk into account and make these higher risk deposits, right? These broker deposits, they're not the same as core deposits, retail deposits. Then what you saw, late 20 teens, FDIC says, okay, we want to try to consolidate all this into a set of rules. And so they passed a series or issued rulemaking that codified a lot of the broker deposit rules, particularly some we're going to talk about today that specifically related to fintech programs, right? They had certain provisions that dealt with exclusive fintech relationships, certain provisions that dealt with, when a broker had some minimal number of deposits that were going into the bank. And then they had this third bucket called the primary purpose exception we'll talk about today that really was kind of core to fintech, right? Meaning if we weren't going out and just buying deposits, shopping around on rates, and instead the whole purpose of me buying the deposits or hosting them was because people were signing up for a mobile app or a website or a service, they said, okay, not going to be treated as brokered. And so, if it's interesting, if you looked at a chart, you saw the steady increase in broker deposits going all the way up to about 2017, 2018. Then you saw a couple $1 trillion fall out of broker deposits across the entire United States. And that's everybody reclassifying what they previously had treated as broker deposits, suddenly treating them as core deposits when this rule came out. And if you look at it, we had this long kind of continuous trend, huge drop. And only this year did we finally catch up to where we were in 2017. And so one of the things we'll talk about today is the FDIC may be getting concerned, right? Is there a couple $3 trillion of broker deposits, hidden deposits that aren't being disclosed on call reports? And part of the rules are designed to bring that back out, right? Make people reclassify deposits. And so it's really going to be interesting as we talk through how these changes may impact that. And particularly if all of a sudden you see these massive changes to the broker deposit rules, what that means in terms of, what banks are willing to take these deposits, how they're going to treat them, or even, how many banks are going to stay in the space if they suddenly treat them as brokered. And so.
Yeah, no, definitely, Brad. And we see that some of the proposed amendments to the current broker deposit rules, we can take a look at that. So the FDIC is seeking to remove the specific definition of broker deposit, which would kind of essentially remove the matchmaking activities prong and replace it with a deposit allocation prong. We also see them wanting to eliminate the exclusive deposit placement exception, making regulations applicable to any third party involved in placing deposits at one or more IDIs. They also want to amend the primary purpose exception, which would be revised in the 25% test to a 10% test. They're going to update the application and notification process for the primary purpose exemption. And they're also going to clarify how an IDI loses its agent institution status.
Yeah, let's talk about that first one because I think it's worth going back and kind of emphasizing that under the existing rule, a broker deposit was just any deposit from a deposit broker.
Yes.
And they define deposit broker as kind of these three broad categories, and they kept two of them. Let's talk real quick about that matchmaking. See, if you think about it back in the day, if I was a bank and I wanted to buy some deposits, I'd have to go up to the market and I'd find somebody who'd match your bank to my bank and I'd buy some deposits from you. So there are a lot of fintechs out there that said, look, we're not doing matchmaking, right? We're just a website with a whole list of rates, right? And you can go and you can pick which bank you want to apply to. And I'm not matching it, but maybe I'm allocating it. So, that first one, we're not going to go into a lot of detail because it's not a huge part of the fintech world. But at the same time, I think it is important that they're trying to take away most fintechs are not one-on-one matching a bank to a bank, right? Matchmaking truly. Instead, they're now saying if you're helping to allocate and determine which bank, right, you kind of serve that purpose, that's going to bring you back under the definition of deposit broker.
Thanks, Brad. So with that, we want to go over what the FDIC's rationale behind the rule was and what the drivers were. we see them consistently relying on safety and soundness concerns, and as Brad was talking about, the fall off of broker deposits as we saw classified throughout the system right around when the 2020 rules came out. But we believe in, as we're talking to our banking clients, that the FDIC's rationale is kind of flawed in this respect, where they're looking at safety and soundness as a concern of these deposits because they view them as not sticky, not core deposits, hot deposits that can move very quickly. Part of the driver of that was the issues that came out of SVB. When SVB failed, a lot of the focus was on fintech money that was on deposit at SVB, but it wasn't deposits that were in omnibus FBO accounts or that are generally associated with fintech businesses with the end user's money. These were just deposit accounts of the fintechs. The fintech silo pulled the money out. Not it wasn't a movement of customer funds that were housed at SVB through partnerships with various fintechs. So the intent behind this rule to make the banking industry more safe, more sound, is not really being accomplished. The partnerships that a lot of the fintech banks out there are deploying are sticky. They take months to set up. Like by the time you work through the MSAs, the economics of the deal, the compliance, the due diligence, you're months in. No fintech wants to pick up and move that very quickly. So this is not a situation where you would see deposits move overnight. It would take months to move to another bank and plug back into another bank partner. So that's where a lot of the comments to the rule are coalescing around. The narrative is that these partnerships are stickier than you think. The deposits associated with these partnerships are stickier than the FDIC believes, and walking through that timeline and how those deposits are most likely going to stay at that bank for a significant amount of time, even if the fintech is moving.
Yeah, that's a good point, Craig. So, I mean, we've talked to a lot of people who have been in these banks that failed. And to your point, it wasn't the payment app that suddenly took all of their customer money and moved it to a different bank. It was actually these like venture capital, private equity kind of deposit accounts, the operating accounts, if you will, these fintechs. They're the ones who, when the Twitter storm started or X storm started, I don't remember which one it was at the time. Uh, that's really what kind of threw us off, right? That's the money that came out of these banks suddenly in a 72-hour period where you had basically a bank run, like old fashioned 1920 style bank run that occurred, but it wasn't the big customer deposits for the fintechs that suddenly flew. Because to your point, it takes months to build these programs, right? Even the fastest, most expert banks probably will take 3 to 6 months to spin up a fintech deposit relationship. That's not something you're just going to flip over on a Thursday afternoon to another bank.
Totally agree. Next slide, Mariana.
So a really big change in the proposed rule is the definition of deposit broker. So currently, the FDIC has deposit broker to include any person engaged in the business of placing deposits or facilitating the placement of deposits of third parties with insured depository institutions, or the business of placing deposits with these IDIs for the purpose of selling interest in those deposits to third parties. The proposed rule, it just kind of amends this definition a little bit way. So it combines the prongs from above. So it says they engage in the business of placing deposits and engage in the business of facilitating the placement of deposits. The FDIC has just expressed their concern that some IDIs have just misapplied this definition. And then a really big change that was proposed was the matchmaking activities that Brad highlighted earlier. So they propose that it be removed and replaced with a deposit allocation provision, treating as a deposit broker any person that proposes or determines deposit allocations at one or more IDI, including through operating or using an algorithm or any other program or technology that is functionally similar. It also proposed to add in a fee-related factor that considers whether a person is paid fees or other remuneration for deposit placement activities that will be added.
Yeah, and that's kind of interesting, Mariana, because that's something we've seen the FDIC asking about, but was not part of that original rule. Is how is the fintech making money, right? And we've started to see those questions during examination cycles. And I think the FDIC has been looking at it as if the bank is incentivizing the fintech, then it is evidence that the fintech is simply harvesting deposits for the bank. Whereas if the fintech is paying the bank, right, to host the accounts, might be the other way, or if the fintech is just simply using the bank for, the back end charter, the payment infrastructure, et cetera, might be a little bit different. So yeah, interesting that they're talking about formally codifying that. And yeah, I gotta believe just based on the number of questions they've been asking in exams of a lot of our banks, that one's there to stay. They're not going to take that one out.
Yeah. And just to go a little bit deeper into the definition of deposit broker, or the proposed definition, the FDIC has proposed that a deposit broker who engages in one or more of the following activities qualifies. So receiving third-party funds and depositing them at IDIs, having the legal authority, contractual or otherwise, to close accounts or move the third party's funds to another IDI, negotiating or setting rates, fees, terms, or conditions for the deposit accounts, proposing or determining the deposit allocations, including through any algorithms or any similar kind of technology. And lastly, having a relationship or any arrangement with an IDI or customer where fees or any other remuneration are exchanged for deposit placements.
Here, another change that they proposed is to remove the exemption for exclusivity. This is kind of not as impactful as one may think. A lot of our banks and a lot of our fintechs have changed their view of how these partnerships work. Going back to what I was talking about earlier, where these deposits aren't hot; they're much more sticky than the FDIC believes. That's kind of the driver as to why you couldn't rely on the exclusivity anymore. There's very few fintechs out there that would allow an MSA to be negotiated for a new partnership that had an exclusivity clause within it. They might set up their first partnership as an exclusive partnership with the rights to expand that in the future, where a current bank partner now can rely on that exclusivity while it's in place, because it is just the proving that it's an exclusive relationship. It doesn't have to be necessarily a contractual term. But removing it is not really going to cause that much harm, as most of the fintechs are now demanding that they have the ability to go to multiple banks, simply because it takes so long to set up a new relationship with a bank, that if your current bank partner, from the fintech point of view, decides that the product offering is too risky, or their regulator determines that they're not staffed properly for the product to be deployed, they may close that product down and exit that space. If they do, that fintech would be dead in the water if they don't have a secondary bank partner that they can port that business over to, because it would take so long to spin up that program. So we're not seeing this as that big of an impact if this did go through. What I would mention is that there are banks out there that do currently rely on exclusivity, or partnerships that have been in place for an excessive amount of time that the fintech has no worries about porting that business over. You may be relying on the exclusivity, and it might be impactful for you, but a majority of participants in this marketplace that are now entering or expanding aren't really relying on the exclusivity carve out to avoid the broker deposit definition.
Yeah, no, I think that's a really good point, Craig, because we've seen a lot of, I think, fintechs get kind of left in a lurch when suddenly a bank decides they want to exit the space, right? Which, I mean, candidly, as somebody who represents banks, we all say, we have this, we joke, it's like the God clause, right? If we don't feel comfortable, or our regulators don't feel comfortable, we can get out of here. And, I think the banks or the fintechs are really starting to pick up on that and are looking to either dual track programs, have failovers, or at least have plans for how they're going to fail over to another bank if their primary bank suddenly decides to get out. It's also worth pointing out one of the things that is kind of scary, and this bleeds into our discussion of primary purpose exception, is as it stands now, there's no provision to grandfather in existing exemptions or existing relationships. Meaning, if you built a fintech program and you've been operating it for the last 3 years under these rules, As it stands now, there's not a provision that would automatically say those same exemptions are going to grandfather in. And so you'd be stuck either reclassifying those deposits or potentially going back and having to, we'll talk about this a little bit later, apply for an exemption or apply for one of the discretionary exemptions or exceptions that the FDIC's proposed here. Other big one that kind of really, I think, made or enabled a lot of fintech was what was called the primary purpose exception. And what the primary purpose exception did is it said there are certain types of relationships between a bank and a non-bank that involve placing deposits, but the purpose is not to shop rate or solely to place the deposits. Instead, what it said is, it was designed to pick up those instances where the third party has a reason to keep the deposits at the bank. And so if you think about it, one of the biggest, I think changes that we saw was a lot of banks were using this, which used to just be an automatic exemption in certain circumstances, to say, look, I'm hosting a mobile wallet. I'm not, harvesting deposits here. And so what they were doing is they were using these primary purpose exceptions specifically to say, not here, not rate shopping. Instead, these are fintech relationships. And look, candidly, and let me use probably the world's biggest example. If you sign up for a PayPal wallet, you're not going on to PayPal to try to figure out who the highest interest rate is, even if you knew what bank was hosting PayPal's money back in the day, right? Instead, you're getting PayPal so that you can send your sister, your half of lunch when you meet each other for lunch, or you need to pay the babysitter or what have you, not because you're out trying to harvest yield on some sort of savings account. But, the proposed rule would revise the primary purpose exceptions in a fairly unique way if there is and they use this term, if it's for a substantial purpose other than to provide a deposit placement service or FDIC deposit insurance concerning particular business lines. And I think that second one's kind of interesting because if you think about it, one of the big things fintechs like is they want to get passed through FDIC insurance, right? There's a set of rules. We know how to comply with it. And if you're putting money with one of these fintechs, one of the questions you may legitimately ask is, are you getting FDIC coverage on these deposits, right? Pass through, meaning, we're going to look past the fintech, go down to the end user level, insure each of those for $250,000. And so one of the things they said is under this proposed rule, they're going to start examining that. And they are also, and this is kind of the other big change, they're going to look at the relationship between the third party and the insured depository institution, not just the third party with its customers, right? So look, there are banks out there that were paying, yield or paying interest to fintechs for bringing those deposits into the bank, particularly really huge deposits. And so just know, if this rule goes forward, that'll be scrutinized. They'll say, well, wait a minute, if this truly is just enabling a digital wallet or a payments platform or something like that, and you're paying a bunch of money to the fintech, you may have some issues. The other kind of main change is the FDIC is proposing to eliminate what's called the enabling transactions test. And if you think about what the enabling transactions test was, it was this kind of automatic exemption. You filed a notice with the FDIC, not an application. And that was really important because, look, applications are taking, depending on your region, 6 to 12 months, if that, to process. And so this was just you send a notice through FDIC Connect. As soon as they acknowledge the receipt of the notice, you've got the exception. And it was kind of a shorter form of the exception. But what it had was these factors that said, look, if it's truly the purpose of the account is just to facilitate transactions between people, and they set out these elements, right? It had to be a transactional account, no fees, no interest, no remuneration to the end users, to the customers, to the depositors for putting that money in there. And so this was truly like the digital wallet, the bill payment type of exception, automatic exception, file the notice only. Interestingly, they're proposing to do away with that, and it'll kick it back to primary purpose where you have to go and apply for an exemption with the FDIC. So pretty significant changes there. And Craig, you may have some thoughts on this because I think this really is probably one of the biggest concerns for a lot of our fintech banks because a lot of people relied on that notice provision, right? Because they were setting up truly fintechs to enable or the fintechs were setting up the accounts to simply be to serve as a bill pay service or things of that sort.
Yeah, it helped with the ease of oversight. It helped with in the exams that when the notice was filed, it made things a lot smoother. Your explanations were easier. Um, the shifting will impact the way not only that you have to diligence or have to talk about the economics of the deal, but it'll impact the cost, the transaction cost as well.
Yeah, and if you look at that, on the screen we've got that quote from the FDIC, but it's interesting the FDIC believes there is no relevant difference between an agent or nominee's purpose in placing deposits for transactions and placing deposits to access a deposit account and deposit insurance. I will tell you that is certainly not what we have seen in our practice working with a lot of the world's largest payments companies that back end into banks or working with big fintech sponsor banks. In fact, I think just the opposite is true, right? Meaning, if there are people who are going out and yield farming and constantly trying to create APY for their customers or remuneration for their customers, or really trying to do truly pass through DDAs, right? We're going to get deposit insurance, high APYs. I will tell you that is a whole different discussion with those fintechs than if the fintech is a digital wallet or a bill pay provider who is looking for a solution, a technology solution whose marketing is we're making this easy, we're making bill payments easier, we're making mobile wallets easier. That's a whole different narrative than I'm out yield farming and trying to, get savings accounts basically for my
I,
customer.
I would say, Brad, that when we were negotiating those MSAs or building those partnerships, a lot of the fintechs don't even inquire as to what the rates are or what it's paying out, or even are aware of that side of the economics of the deposit accounts. They're purely just looking for operational functionality and how can we move these funds for payments, for bill pay. They're selling customer service, not rate at all.
Yeah, and then the other kind of main, what I would call easy exception to that was created in the primary purpose exception, an easy one to make, was this concept that if a deposit broker puts less than 25% of their total assets with a particular depository institution, then you fell under this automatic exemption, right? The sub 25% rule. And look, it was designed to help broker dealers, investment advisors who had custodial relationships with their customers who were having to put money in insured deposit accounts like a sweep. And what it said is as long as less than 25% of the total assets are going to a particular IDI, then it was going to enable that or give you the automatic exemption. I think what the FDIC saw, if you read the commentary to the rulemaking, is that people started to abuse that. And so a fintech would try to come up with five different banks. And I'm going to put 20% with each of five banks. And it really wasn't just being used for broker dealer sweep type transactions. And so the new proposed rule drops that down to 10%, and it says it is designed for broker dealer sweeps, right? Our traditional, hey, take one of the big brokerage houses, I don't know. Uh, and at the end of the day, any money that's not invested that day into the markets, we got to put it somewhere. We got to insure it. And so they're going to sweep it over into insured deposit accounts at some kind of bank, right? So take like JP Morgan Investments. They move the money each night into a Chase sweep account. It's less than 10% of their total asset book. That would still be fine, but you couldn't have a scenario where a fintech is farming deposits to five different banks, 20% at each, and trying to like backdoor into the 25% rule. And so it's really going to be limited just to broker dealers or investment advisors.
And so another change as well is who will be able to submit a notice or application. So currently, under the current rule, this could be a third party or an IDI. But under the proposed rule, the FDIC is now stating that only an IDI can submit an application. Now, the rationale behind this is that the FDIC has found that third parties often provide insufficient information, and there are often misunderstandings among the IDI regarding approval applicability. So this will be a complete change. Only the IDIs will be able to now submit applications.
And I
This
don't
one,
know that, or go ahead, Craig. I mean, I don't know that's the end of the world because I mean, heck, when
Yeah.
we're representing banks, I mean, Lashani, I mean, we do a ton of these, applications or notices, exemptions.
Yeah.
Last thing I want is a fintech talking to my regulators of a bank and, saying something they shouldn't.
Yeah, we're mostly finding that the banks are submitting the application to begin with, so not a major thing here.
Craig, you want to talk a little bit about that process then and some of the changes there?
well, I was going to say that I was echoing your point where the move over to the bank itself, like not only do we recommend it, but uh, it's better for the exam period, everything. Like we would rather have that line of sight, that the confidence around how it's being processed, and as far as delays as well, like it goes much slower when the fintech has that aspect under their purview.
Yeah, and this next slide I think is kind of important because it's additional information that's going to be submitted as part of a primary purpose exception. And if you're a bank and you're reading through this, or you're a fintech, you're reading through this, listening to this presentation, this, I think, is kind of the FDIC's playbook. These are the things they're concerned about. And it's almost like when you're doing a transaction, somebody updates the diligence list suddenly to focus on something, like read into that. Yes, these are areas of concern. And so you see on the screen, we've got the existing information that had to be submitted as part of the PPE, the primary purpose exception application. But look at how it changes. And I think this kind of gives us a little bit of an insight into the FDIC's playbooks. They're looking at how the economics are working between the depository institution and the fintech or the broker, how the economics are working between the fintech and its customers, and I think really trying to ferret out who's actually paying who for what, and they're going to use that as evidence of what the true intent is, right? Meaning if fintech is, supporting the bank, right? I mean, kind of bizarre circumstance. We're paying the bank to host our deposits. Okay, that's probably very good evidence that it's enabling transactions, right? The bank is doing something to support your digital wallet, your bill payment service. But if the bank is actually paying the fintech, right, giving them remuneration, probably pretty good evidence that the bank is actually using it to harvest deposits, right? They're trying to purchase deposits. They're also going to really look at, does the agent have discretion to choose the IDIs where it's going to be placed, right? They already had some questions that got to that question, but I think here they're really going to narrow down. Give me all the data you have about what the rights are of the fintech to choose the insured depository institution. Is there an absolute obligation for the agent to disperse the funds to the customer deposit accounts, right? Meaning, is there any discretion the customer has to say, like, again, take PayPal? I want to keep that in my wallet. I don't want to disperse it, or I want to move those funds out to another external account, right? If the agent instead has to move those funds, I think the FDIC is going to look into that a lot more closely, and you're going to have to provide copies of all the relevant contracts. In the original rule, we had to describe those relationships, and I think if we're reading between the lines, people were getting a little lawyery in describing those relationships and being very careful about what they were saying, and leave it to a JD to try to do a little wordsmithing. And so now the FDIC is saying, okay, nice try, fellas. Just give us the contract, show us the actual agreements. We want to see how the economics are working and what those rights and obligations are between the depository institution and the agent or partners.
How flexible, Brad, do you think that the FDIC is going to be in that analysis, given that in 2020, when those rules were first amended, the narrative around the amendments were to give clarity for fintechs and kind of give fintechs some confidence in how they were going to classify the deposits and give them the ability to bring services to more depositors or more end customers. Do you think that we'll see an FDIC if this portion of the rule goes through that is fintech friendly on the analysis, or do you think we'll get significant pushback?
No, I think if it goes through as it's designed now, you'll probably get really significant scrutiny. It is kind of bizarre in that, the reason we all love those changes to the broker deposit rules is there were still some kind of bizarre edge questions. But they had really good FAQs. We knew what worked and what didn't. You could design programs that kind of fit in that box. Here I think what you're doing is you're creating one edge that's going to be okay, one edge that's not okay, and a whole lot of gray in the middle. And look, if you're a bank and you're trying to negotiate contracts or plan these relationships or even do risk assessments, right, so that you can quantify risk of a partnership, this makes it a heck of a lot harder because then you're going to get into this whole question about, am I going to ever sign a contract with a fintech before I know if I can make an exception or an exemption, right? It's this kind of bizarre cycle that hopefully the FDIC takes into account that without kind of clear rules of the road, I'm doing due diligence, I'm doing contracting, right? Take our third party risk management cycle. I'm doing business use case, business case, due diligence, contracting, risk assessing. And I'm doing all of that without even knowing how this relationship is going to be treated by the regulators. And look, that's scary to me as a banker to not
Yeah,
have that certainty.
I would think the MSAs for the partnerships would be built out with two pathways, right? Like if you're going to get the grant, or if you're going to be declared a broker deposit.
Yeah, no, I think you're exactly right, Craig, is that, and that's certainly the approach we're taking with a lot of our banks, is we're going to start basically saying, path A, path B, and your pricing may change if you're path B, your risk ratios may change if you're path B. We may even eliminate the relationship if you're path B, right? It just depends on, if one, as a bank, I want all those broker deposits and do I have the capacity to eat that much?
And piggybacking off that, like those are the kind of impacts that you'll see if the proposed rule goes through with any kind of if it complies with the proposed rule. If it goes through as is, you'll see impacts around the cost of building these partnerships. Like Brad and I were just discussing about the MSAs. Like that's going to cost more. Transactional costs will just increase. Your time will increase. You'll see longer time to market with your partners that are out there. The FDIC is expecting a drastic increase in applications, obviously, because the rules that we just walked through are going to drive the volume that way. We think that the third parties are going to face an increased cost with updating systems, policies, and procedures. But I do want to say, and I do want to remind everybody that the confidence level that it goes through exactly as written. Brad, what would you say? Do you think this goes through or receives significant pushback?
I think they're trying to ferret out some comments here, and maybe that's me being optimistic. But this is just such a swing back over. I've got to believe they're gonna. And I mean, let's be honest, with some of the changes to Chevron deference that came through the Supreme Court last term, where they're going to have to really meaningfully, I think, respond to comments they get back on this thing. I gotta believe they're going to move a little bit back to giving us some certainty on these relationships as opposed to sticking a bunch in the discretionary application. And then, the other thing that just, to the point you just made, Craig, is it's already taking a long time for applications to get processed. Imagine now that every fintech bank in America starts bombarding their region with these discretionary applications that now have even more information, right? Because we're asking for more. And now you're going to have to assign exam teams at the FDIC to work your way through all of this stuff. I mean, it just seems like, if we can get a little bit more certainty while still protecting, I think what the FDIC, rightfully says, a legitimate interest to kind of classify these deposits. I got to believe they're going to try to give us a little more certainty.
I would agree. I'd also say it's important for all of our clients to digest the changes in the proposed rule, but also the comments as they are published are going to be just as important. Like this is going to pivot and kind of mutate as those comments are taken in by the FDIC and really thought through.
Yeah, and I think to your point too, Craig, it may also, I think, kind of cut into the haves and have-nots, meaning if you're a giant bank, you're a $60 billion bank, $70 billion bank, you may not care if these things are brokered, right? You got plenty of balance sheet for it. And, the only kind of scary thing there is, and maybe this is one of the purposes of the FDIC changing these rules, is this is going to have a lot more meaningful impact on small banks with smaller balance sheets where they're having to reclassify a big group of deposits as opposed to, you're one of the giant conglomerate banks and, you know, not a big deal if you stack $1 billion of broker deposits on your call report.
Yeah, I really thought that the way we've been treating this over the last couple of years really gave smaller institutions uh, an ability to grow against their larger peers. And with this, if these changes go through, you'll see that taken away. And I don't necessarily think that's a good thing. Next slide, Mariella. This is if the rule did go through. What do you have to think about? Generally, it's similar advice to any rule that's out there. If your deposits become broker deposits, you have to think about your controls around that, what the policies and procedures look like, establishing minimum CDD procedures. You should be doing this anyway, even if it's a core deposit through the fintechs. But you'll have to kind of change where those policies and procedures and controls are housed, right? You'd have to show them internally as well, because if they are broker deposits, you don't necessarily need to know who that end depositor is to the extent that you would of a core deposit. So you're going to have to put controls around that and put the identification documentation together and the CMS framework around that.
Yeah, and Craig, one of the other things we saw recently, that we talked about in our last webinar on broker deposits, that bad timing was days before the FDIC meeting, or good timing because it gave us an opportunity to do part two of this. Is the FDIC kind of silently changed its liquidity management guidance related to fintech deposits and potentially making you treat those as wholesale deposits under the liquidity management guides. I think it's just even more of a focus now of the FDIC. Like, look, if you're going to hold these things, you better be planning on it and really carefully risking it, whether it's just the kind of A or B brokered or core, or this kind of more generic concept that FDIC inserted that these are wholesale deposits and you need to be planning for potential liquidity events associated with these because they are considered higher risk than just a traditional retail deposit.
Yeah, you can't say you couldn't have seen this coming. Like in the exams, I've had EICs ask about how we're treating the deposits, even though we were treating them as core deposits and we had the proper broker deposit analysis around, and we were documenting proper exemptions, classifying them as core deposits. The exams team still wanted to know how we were treating those deposits. Were we giving them the same leverage as our core bank core deposits? So you knew that they had issues with the way the rule was being deployed over the last couple of years, and I think that's going to continue. One thing that I would take away from this is it's an indicator that broker deposit analysis is going to continue. Like that's going to be a focus even before this rule is finalized and before those comments come back. Just given the amount of discussions we've had around it over the last 2 weeks.
Yeah.
And I think that's it, Brad.
Yeah, I mean, like I said, you mentioned the BSA AML risks, and I think, as we're thinking about what those next, 12 months look like, one, monitor this. ABA, ICBA, lots of trade organizations. We're working on a comment letter to the FDIC. I think especially if you are a fintech focused bank and you have information about the quote stickiness of these deposits, that's the kind of data the FDIC needs to see, right? Because that's ultimately what they're trying to get at is how likely are these to run? And forgive me for getting on my high horse one last time before we wrap up, but that's really, I think, what the FDIC panicked about is if you look at SVB and kind of the late 2023 bank failures, the DIF, the Deposit Insurance Fund of the FDIC, is not able to eat that size bank failure, right? If that size bank fails, and the Federal Reserve and the Treasury doesn't support those deposits, the DIF, Deposit Insurance Fund, is just not sufficient to eat a bunch of these big fintech bank failures. And so I think there's a little bit of panic, like if you read, they call them the after action reports that came out after those. There's a lot of mea culpa for the regulators saying, we didn't realize the riskiness of this. I think the real concern here is, are you looking at the right risks? And I think that's really where the data's got to be provided to the FDIC to provide a meaningful comment back to this stuff, is really get in the data and say, especially for fintech focused banks, is it truly risky, right? What is the likelihood one of your fintech partners shifts banks, or in the event of a Twitter storm or an X storm or whatever you call it nowadays, if that happens, what's the likelihood they yank all the deposits out of your bank? And I think that's really the challenge that the FDIC is faced with. And, credit where credit's due. I appreciate the fact they're looking at it because it is a major concern. But, I think the more we can solid up the rules, the better we're going to be.
100% agree.
Okay. Any final thoughts from the crowd here?
Just I would reiterate, it's something to follow. Like, you really should be, tracking those comment letters as they come in. If, like Brad said, if you are a fintech focused bank, you should really be trying to gather a narrative around the stickiness of the deposits, and maybe submitting a comment letter to the FDIC.
Yeah. All right, folks. Well, thanks so much. Again, one last shameless plug. Join us August 26th in Atlanta, day before FinTech South. We'll be hosting FinTech Banker School, which is a meetup between regulators, banks, and fintechs who all work in the space. We'll be talking about the broker deposit rules, 1033 rules coming through, new third-party risk management guidance, really looking at industry experts to give us some guidance on that. So, feel free to sign up at the website. Let us know if you have any other questions. And certainly, if you want feedback, if you want to provide feedback, you need information about filing comments to FDIC, feel free to reach out to any of us. But really want to thank the whole team who's been working through this. We've obviously been busy working with our bank clients directly, trying to address how this change is impacting them, and been doing little mini webinars for each of our clients. But wanted to get something out there that was available for the whole world here. And so let me start by thanking Mariana and LaShania for putting together this presentation and really kind of spearheading a lot of the work going through dissecting these changes. And as always, my old partner dating back to COVID when we started the In the Trenches series, want to thank Craig Nazaro for joining us as well and working through this stuff. So with that, we'll be signing off. Thanks everybody, and feel free to reach out with questions or thoughts.